Hello, everyone. Welcome to MCT's webinar on new bid tape AOT executions. Thanks for taking the time to join us. My name is Ian Miller. I'm the Chief Marketing Officer here at MCT, and I'm going to introduce your speaker today, Phil Rizzori, the Chief Operating Officer and Head Trader here at MCT. Phil's experience stems from over 15 years providing best execution analysis to our lender clients, and Phil's been leading the digitization of whole loan trading with the development of MCT's Bid Auction Manager whole loan trading platform. He's been on the vanguard with these new executions and is going to be explaining the details of how those will impact best execution for all of you today. Phil, thanks for joining us.
Well, thanks, Ian, and appreciate everybody for getting on the line here. This is a very important topic, and it's definitely shown with your user the attendee list here. We're expecting about 320 people on the line. So the reason I bring that up is we're definitely going to have a wide range of experience levels here in the capital markets industry. So what I'll do is I'll try to thread the needle, giving a little bit of background on what an AOT is, a little bit of history, and then get a little bit more specific with regards to how this new bid tape AOT is executed, priced, and the benefits of that execution. You're definitely going to have questions, I think, on both sides. For some of you, this is probably going to be a little bit too granular, and too much into the weeds in the actual execution portion. For those of you that are more experienced in secondary and capital markets, you probably have some additional questions that I may not cover. So we will give some contact info at the end of the call here. So just gonna jump right in from just kind of giving some history on the best execution environment that we've seen over the last 5 years. As everybody remembers, beginning in middle of 2013, really, the taper tantrum, May and June, that extremely quick rise in rates created the mortgage asset to become in vogue, really, for the first time, really, since the beginning of quantitative easing, and that drop or perceived drop in prepayment speeds, led to a lot of Wall Street interest, private equity interest in the mortgage asset, in MSR. And so, of course, what happens is there was a substantial increase in aggregator entrance into the buy side. This basically meant that if you were immediately entering the space, you didn't have the requisite AOT direct trade, or I should say AOT approvals with broker dealers set up, and it was easier to buy on a bid tape basis. And so, just to name names, PennyMac and Amerihome should be, I think, referenced here, because they were two of the first that really pushed the bid tape execution into the agency space in late 2013, early 2014. So then, of course, the granularity within the asset accelerated. You'll hear terms spec pay-ups, not to get too much into the terminology there, but if you get a low loan balance of sub 85, under 85,000, you'll get a pay up because of the perception that this borrower is not going to refi as quickly given a drop in rates, because it doesn't make economic sense for the drop in rate. And so, of course, from a securitization perspective, those are more valuable. When a trader is calling up a direct trade desk to say that I've got 2 million Fannie 4s for X month, it's not feasible for them to verbalize all of these data points. So the bottom line is that, bid tape execution began to dominate as lenders became better at, through their LOS, providing these data points to ourselves and MCT, other hedge advisors, and then of course as investors became better at assimilating all of these data points into sharper pricing, bid tapes began to dominate direct trade AOT. And then you had, basically, Fannie Cash Window, you had Ginnie over the past few years, increasing their approvals. The reason I bring all this up is that there's a lot of non-assignable executions that were dominating the market. And so the bottom line is that really for the past 5 years, the AOT has pretty much completely died off. And that really changed at the beginning of this year when Wells Fargo brought their bid tape AOT program to the market, which we're gonna talk about all the programs out there a little bit later. Actually, just to speak to that for a second, there are about 6 programs currently running right now, bid tape AOT programs. We're going to talk about this in detail, but these programs work at scale. And so the 3 that we're going to kind of focus on as far as being automated within our platform, and the ones that you'll see most often right now are going to be Wells Fargo, Amerihome, and PennyMac. But there are other programs that we'll mention as well. So just to, again, this is going to be basics, just to talk about the definition of an AOT here. The TBA position is assigned from the lender to the investor. Tri-party is executed, so the 3 parties involved are is the lender, which is the assignor, the investor, which is the assignee, and the broker-dealer, which is the buyer. You'll hear the term assign or seller. Those are used interchangeably. And of course, we're talking about the TBA position now. So the lender, if you're a lender, you are short that position. You are a seller in that position. Then what we do is we deliver the loans with the corresponding coupon and product into that trade, and then basically what happens is that the original price of the initially executed trade, the TBA that we're assigning, becomes the basis for the trade price. And I'll talk about that for the trade price of the loan, and I'll talk about that a little bit in the next slide here. So the benefits of AOTs are pretty, they're substantial. From a bid offer spread perspective, when we talk about bid offer spreads, a lot of people talk about dealers. So, there's, recently the dealer space from the independent, small to mid-sized independent mortgage banker has gotten more efficient. Kind of the market standard out there is a half 30-second, or 1.5 basis points off of screen for a small to mid-size mortgage banker. And let me take a step back. This is, when we talk about bid offer spreads throughout this presentation, we're going to talk about it in the context of a small to mid-sized mortgage banker. There's no question that if you're larger, if you're doing trades in excess of 10 to 15 million, you are definitely going to get inside of the screen on a consistent basis. But this is going to be for your small to mid-size lender who, is thinking about, should I start to look at bid tape AOT execution? And so bottom line is that the execution benefit is the fact that you don't have to pair off of the corresponding security. You're going to assign that security to the investor, and you're going to deliver the loans against that trade. Biggest thing, obviously, that novices, think is, okay, I've got a $50,000 pair off on this trade, and if I assign it, that pair off just disappears. And that's not it does disappear, but it obviously doesn't disappear from an economic perspective. That $50,000 is wrapped into the loan purchase price, and so you basically get, as your effectively executed trade gets wrapped into becomes the basis of your loan trade. So again, just using our example here, if I assign 2 million Fannie 4.5s with an original price of 101 3/8, let's just say that my loan execution is at 101 7/8. Current market is 102 3/8. I'm using this as an example. So what that means is we have seen a 100 basis point rally in this position, and again, you as the lender are short that position, and that's going to mean that your trade is 100 basis points out of the money. So for 2 million, there's a $20,000 loss associated with it. When we assign the trade, basically it's just going to take the loan value and drop it correspondingly in a linear fashion down to par, spot 875, par and 7/8. So that's going to reduce your loan execution accordingly by 100 basis points. So key here to understand, for everyone not familiar with an assignment of trade, is that the $20,000 loss does not go away, right? The $20,000 loss is wrapped in and incorporated into the price of the loans that are being delivered and purchased by the investor, by the aggregator. The savings, the actual value, is going to be in the bid offer spread. Generally, like I said, you've currently got, and we're gonna talk a lot about bid offer spread later in the presentation. Generally, for a small to mid-sized lender, Tradeweb or Bloomberg will show you a bid offer price, differential of somewhere about 1/32. So it's about 3.125 basis points. And then there is generally going to be a mark, again, for smaller trades, of about a half of a 32nd off of that offer price when you pair it off. So now you're talking about basically a 4.5 basis point differential there. So that's a sizable savings. Now I should say that there are methods that we've been following for a long time, and not just MCT, a lot of market participants follow this, which have reduced bid offer spreads historically. So specifically, I'm talking about trade recycling. So in any living, breathing pipeline, you have new loans coming into that pipeline, and you have new fundings and commitments exiting the pipeline. And if those new loans are of the same coupon and product of the loans that you executed to the investor, you can use that loan sale to the investor as an effective hedge for new production coming into the pipeline, thereby recycling the trade. Instead of pairing out of the trade and immediately selling a new trade for new production, you've recycled the trade. So there are ways to minimize the bid offer spread, but the bottom line is because you have to roll that security, you do have to pair out of that security at some point. A bid offer spread exists nonetheless, always exists. So in a perfect world, when I talk about, back up here of, non-assignable executions dominating the market, the only reason they dominated the market is they had better pricing, and there was a lot of executions that were non-assignable. All things being equal, if there's an assignable execution and a non-assignable execution and they equal in price, we are absolutely going to take the assignable execution. But that just simply was not the case at scale until February of this year. So just comparing the bid tape AOT versus, I'll call it legacy AOT. So again, I've just defined AOT here, and now one of the reasons, and again, let me just go back up. I know I'm skipping through slides here. Let me go back up to our best execution environment over the last 5 years. So the reason I mention all of the non-assignable executions, if you think of, let's say 30 million a month of volume, and you split that 60-40 between conventional and government. So now you're at 18 million. And let's say that in the last week of the month, you fund 40% of that volume. So let's say you've got around 8 million that you've funded in the last or 9 million in the last week of the month. Now you split that between coupons, and let's say that the market coupon, and I know we all don't like to admit this, but this is with last week we've seen a increase in that market coupon, but let's just say that we're still cruising at a 4.5 now. Let's say the market coupon accounts for half of that volume, so we have 4.5 million in the that we're able to sell. And again, this is using an example of a 30 million a month lender at the end of the month with 1 week in their primary funding. So this is the time where you're going to sell the most volume. If I have 4.5 million in a coupon to sell and I wait that entire week and bulk those up, I now have to spread my executions between all of the bid tapes, all of the cash window executions if I'm an agency seller. And so I get to a point where there's very little product going to an assignable execution. So when we go down here and we talk about, current versus legacy, we'll talk about blending and trade tolerances. I know I'm going to skip down to the second bullet point here, but in the past, there was tolerances required, meaning that if I assigned $1 million trade, the corresponding loans would have to come between 980,000 and 1,020,000 for a 2% tolerance. If the investor had a 2% tolerance, generally was between 1 and 2% for most investors. And that was virtually impossible, for smaller lenders. So, with the changes that have occurred in this new bid tape product and this bid tape AOT product, there's an automatic blending that allows us to basically assign a trade against, within ranges, which we'll talk about. Assign a trade against a population of loans, and then the loans are priced accordingly off of a weighted average AOT strike differential. So we'll talk about that later, but that's a huge difference. And the reason I skipped down to that second bullet point is, although it's not the biggest difference, that is the difference from an operational perspective of why this type of assignment of trade is going to be a lot easier to swallow for a small to mid-sized lender than the legacy programs of the past. So the most important differential, and again, I'm gonna this is going to be more for participants in this call that have done AOTs in the past, is the biggest difference is the immediate AOT acceptance. So we would always get calls in the good old days of quantitative easing, where January of 2009, we would get calls and say, okay, I want to assign all my trades because I'm getting mark-to-market margin calls from my broker dealers. What that generally means is that if your trades go a certain distance out of the money, the broker dealer will call you for a margin call, basically bringing your value back to zero. So if your trade positions, let's say, are out of the money $500,000, they will call you for a $500,000 wire to bring it back to zero. Most of you have heard of FINRA 4210, which never seems to actually get implemented, but it would actually require broker dealers in its current form to call you at a $250,000 FINRA broker dealers, I should say, at a $250,000 de minimis exposure. So, bottom line is that from a cash perspective, a big rally meaning that rates are dropping, your short positions are going out of the money rapidly, that can truly pose an existential threat to the organization because of the fact that you are now required to outlay this cash against assets that are substantially in the money, which is your pipeline, of course, but your pipeline has not funded yet. And so, going back to the days of quantitative easing, when we had those big and sometimes violent rallies, we would get calls that they, lenders would want to do additional AOTs outside of what they normally had done. Again, this is pre-2013. And the issue, of course, is that the investor is not stupid. The investor is not going to take a bunch of trades substantially out of the money and wait and hope that the loans get there. So most dominant AOT programs out there required, somewhere between 50 to 100% of the collateral to hit their doorstep before they actually accepted the AOT. And so in practice, what this means is if you're getting called from your broker dealer for a $500,000 wire, and you assign a trade, the problem is you've sent that tri-party to the investor, but the investor has not executed the tri-party and sent it to the dealer. And so therefore the AOT has effectively not cleared, and thus the AOT is basically meaningless from a margin perspective. You still have that exposure at the broker dealer. And so now in these new programs, and this is a credit to really all of the lenders on the phone, these new programs, because of the fact that bid tapes have so extremely short delivery periods, a top investor had mentioned to us that 50% of our clients' bid tapes, bid tape volume that is executed at their desk is delivered same day, and 80% is delivered within 2 days. You can see that that's a dramatic difference versus 5 years ago when you would have the classic, the term that everybody would talk about was like a 7-day delivery. That world has changed. And so there's also other operational reasons that the investor will like driving that bid tape AOT or that assignment, that tri-party directly to the dealer. But the bottom line is it is immediate exposure relief. So that is a huge difference. That makes the AOT a very powerful weapon with regards to margin issues. Now, you have to have the loans, but provided that you have the loans, if you assign all of this exposure, it will be accepted at the investor immediately, and you would not have to make that wire. So that is a fundamental change, a true paradigm shift in exposure. And I've talked about this with investors. Actually, John Kerrigan and I at Wells have talked about this a lot. That although from an investor perspective, it could seem that immediate AOT acceptance would increase risk to the investor, I think the argument can be made that there is substantially less risk because in the event of an error, that assignment is immediately driven through to the dealer, meaning that if I think, and let's use last week for an example, where we've had this, in the last week, we've had this, rise in rates. And so, of course, what that means is you've had trade positions go in the money, you've had your loan positions go out of the money. So let's just pretend for a second that I assigned $2 million to Wells or Penny or Amerihome or any of these programs, and I accidentally, for whatever reason, I assigned 2, but I only wrote down on my trade blotter that I assigned 1. So now we have a tank in the market, and we have a situation where I think I've got $1 million more in my hedge that I actually don't have. And so in the old world of the legacy AOT programs, that AOT would not get driven through to the dealer. So the dealer's not going to know that that was assigned. They may not even know that that was assigned until actual notification or settlement date. So what's going to happen is we're going to go through all this market exposure, and I'm going to think I have a million more. And so if we just think of the point that we lost in the last week, that would be $10,000 just on a million. So you can see that in this example, where this new bid tape AOT program, where there's immediate AOT acceptance, we're going to drive that, or the investor is driving that tri-party directly to the dealer. They're immediately going to know that there is 2 million assigned and 1 million, and you're going to be able to see that when you're reconciling your trades. So that's extremely important from a standpoint of risk. So additional, and I'll talk about this a little bit more when I've got some numbers on slides, but some additional advantages, and I'll say more about the automatic blending as well in some examples. But some additional advantages is you can combine TBA positions. So let's just pretend for a second that I've got 2.2 million in Fannie 4s, and I don't have a $2 million trade. In the past, I would have had to have broken that up into, let's say I got 4 $500,000 trades. In the past, I would have had to have broken that up into, $500,000 increments to see if I make the tolerance. Hopefully I did, and I can assign some of that. Now I can assign all of those trades against that volume, and I get a weighted average price. Basically, if we think back 15 years ago, I remember times when I was trading that I would be telling clients to hold off, when they're bringing production in. Again, we're talking about small lenders now, but if we bring a few loans in, hold off making a trade, and because we want to make a larger trade so that we have the ability to assign down the road to make the tolerances. In this case, that's no longer needed. Obviously, from as you guys all know, who are dealing with this on a day-to-day basis, intraday price volatility can come up like it did in the last week, and that can be very risky. So again, the blending allows the user to combine trade positions. So that's another big advantage. The acceptance of e-signatures on the tri-party is huge. The efficiency, I won't take everybody on the call through all of the pain of manually entering trade information into the Schedule A of the tri-party, signing the tri-party, and then entering the trade information, trade blotter information to the corresponding dealer and sending that information. But needless to say, it takes a lot of time, and if you want to talk about archaic, there literally is still fax numbers on a lot of investor tri-parties. So using myself as an example, I have computers in a couple offices, and none of them are hooked up to printers. I realized that earlier this year when I was when we were trying to look at automating tri-parties. So the bottom line is that allowing the e-signature on the tri-party allows groups like us to automate that tri-party, and more important than the efficiency, and it is a big efficiency gain. If you have to, again, for those of you that have filled out tri-parties, if you do 10 assignments in a day, that's a substantial amount of time. But more importantly than the efficiency advantage is the removal of human error. And although we've the immediate acceptance definitely reduces risk of the human error, there's no question that entering a wrong price, or better yet, a wrong volume or coupon into a tri-party is extremely problematic. And then the last differential, and I'll talk about this a little bit later as well, is the tri-party is transmitted at the time of commitment request. So if we talk about our platform, Bulk Acquisition Manager, Bid Auction Manager, what we are doing is there's 4 communications in a bid tape, and so the MCT client will post a bid tape to the platform. The investor will upload their bid levels based on that tape, and then the best execution analysis will be performed. The third data transfer will be a request for commitments, meaning that what loans the corresponding investor won, and the fourth communication will be the confirm of those commitments coming back from the investor. The tri-party is now basically transmitted at the point that we request the commitments. The reason that's important is it speeds up the process. We now know at the time of commitment request that those loans are committed. So there's definitely an efficiency gain there as well. So I'm now going to talk about, getting into kind of how the bid tapes or bulk bid levels have evolved into bid tape AOT executions. So initially, we really only needed, there's only 2 pricing fields that are absolutely essential from a standpoint of taking a bid tape, or I should say an investor uploaded bid levels and putting it into a best execution analysis. And that's just loan number and all-in price, right? So you don't need the SRP, you don't need the base price, you don't need the incentive, provided that the investor is correctly putting all of your lender-specific incentives into the price, into the all-in price. You really only need 2 data points. However, what happened is, as more and more investors entered the bid tape space, and this starts in, let's call it 2015, what happened is we had some investors would come back in 90 seconds, some investors would come back in 90 minutes. And so it required market participants like us to adjust for market levels. So there would be a little box up here called TBA market indications, something to that effect. The issue, of course, is that the investor, the aggregator, is driving some of these loans into certain coupons based on spec pay-ups. Now, I have a $250,000 loan amount here, so from a volume perspective, I don't have a good example, but if this was a non-owner-occupied loan, there is spec pay-ups available for that particular loan that could put, most of our clients would drive this into a 4 coupon, but there are pay-ups available that would allow the investor to drive this into a 4.5 coupon. So for us to be able to accurately adjust pricing, to true up and reconcile all of the different investor bid tapes, we needed a loan level market spot on each loan. So basically, we pushed most investors, and a lot of investors did this without our communication, and there was a lot of sellers in the market that were pushing for this. We pushed investors to move to a loan level market spot where you could find security type, coupon, the actual month that this thing was priced to. From there, it became very easy to then take a look at, okay, well, if I assigned a trade, I could just basically take a linear adjustment from the price. So going back up here, what this is saying is that here's my loans in my bid tape. I've got different note rates and loan amounts. Loan amounts are all the same. Here's my pricing. And these were all priced in the investor's pricing model based off of a Fannie. This is the security type. FNCL is the Fannie 30. And they were all priced on a Fannie 30 for coupon settling in the month of November at a security price of par. I could have used a market coupon, but I think that would have been painful for everybody, including myself, to see fives and five handles in here. So we're sticking with the fours. But basically, when I put these slides together, we were around par on the four. So if in that sense, this is how these loans are priced. Now, what we need to do in an assignment, as we talked about earlier, is the original AOT price and what we refer to as an AOT strike. That's going to become the basis of your loan price. So there's a couple things going on here that we need to talk about. We talked about in the definition of an assignment of trade that the AOT becomes the basis. So using this as an example, our current price is par. So that's under this current value here. Our AOT strike price, this is the price that we sold the trade at, is at 101. Now, my earlier example, I was using a trade that we were assigning that was out of the money. To be clear, this trade is in the money. And again, the reason I use that is that's the current environment. So if you would have sold this thing a couple of weeks ago, you probably would have sold it around 101, and now it's worth par. So again, because we're short that position, we enter the trade by selling. The market has deteriorated, and we could buy it back for a current price of par. Again, this is the bid price, but we could, the current bid price is par, so we've achieved 100 basis point gain on that trade. So there's a delta of 1 there between the AOT strike and the current price. Okay. Now the key difference here, and this is where everything changes versus the past. In the past, I've got an example here of 5 loans. These 5 loans equal $1,250,000. In the past, basically what would have happened is we would have had to have taken these 4 loans for $1 million and put it up against that $1 million trade. Now that's not the case anymore with these new programs. Basically what happens is that it's an automatic blend between basically on a weighted average basis, we're just taking that strike delta of 1, and the weighted average delta, basically trade to loan amount ratio, is, as you can see here, 4/5, 80%. So our delta, and again, it's not, this is where the simple numbers hurt me a little bit. This is 100 basis point delta between the AOT strike and the current. I'm multiplying 80% times the delta. So just to be clear, if the delta was 2, the weighted average delta would be 1.6. I think that's clear to everybody. So in my case here, I've got a weighted average delta of par 0.8. 0.8. The security price was par. What we're going to do with this 0.8, and again, this is we're going to apply this 80 basis point positive adjustment, again, because the trade that I'm assigning is a point in the money, and it is 80% of the value of, or the volume of the entire bid tape pool here. I'm going to apply that 80 basis point pickup to every loan, all 5 loans. Again, in the past, we would have only taken 4 loans, and we would have applied 100 basis point pickup directly to those 4 loans. Now, I'll talk about how we handle this in the Best X in a minute, but with regards to the pricing, it's essential that everybody understands that we've got an we've got a weighted average AOT strike delta being applied here, and we're going to add that pickup to the all-in price to get us an AOT adjusted all-in price over here on the right. Before we even get into the best execution, I can tell you that the best execution is always done on a current market basis. So we're going to take that all-in price. Now we are going to bias it based on our savings that we're allowing, for the given trade and the given investor, but we are always going to best X off current pricing. So let's talk about an under delivery, because this is where things get a little bit more exciting. So flipping back here, I just talked about delivering 1.25 million against a million. That's over delivering against the trade. Now let's say I had those 5 loans, and those 2 out of those 5 best X to some other investor, non-assignable execution. So now I've only got 750,000. These programs will allow you to round up to the nearest million. So what that means is that you are now in a position where we can assign a million against 3 loans, or 750,000 in loan volume, more importantly. And using the same math, you can see that we now have a 1.33 weighted average delta. Pricing, exactly the same. Our delta, again, we're using, to be clear, if this delta was 2, so let's pretend for a second that this AOT strike price was 102. That means that the trade was 2 points in the money, so the delta would be 2. We would have a 2.66 here. So the 1.33 is just the actual delta, and then it's going to be applied to the corresponding loans. I talk about where this is where things get a little bit interesting, and I'll talk about that later in the best X. So just before we get into the best X, the best execution strategy on these bid offer is basically on these bid offer on the best execution strategy for incorporating the bid offer savings is basically you're going to apply the appropriate amount to the appropriate and applicable trade. And so if to get that appropriate amount is basically what we're going to do is we're going to adjust basically the theoretical economic value accordingly. So let's use the example, and I'll use an example in the future here, actually in the next slide. But for the best X calculation, the goal is to think of the total bid offer savings created by the given loans and apply it accordingly. So what I'm trying to say here is that if we think about 750,000 in this example, because we are able to assign a million, okay, we are relieving ourselves of the cost of $1 million in pair offs, right? And again, we're not getting rid of the pair off, but we're relieving ourselves of the cost of $1 million bid offer spread. So what that means is that your savings is actually not going to be just your bid offer spread, because the fact that although you're selling the 2 loans elsewhere, you're allowing yourself, by assigning these 3, to save the full $1 million. So that's kind of what I'm trying to say there. So let's just go into the example. So equal or over delivery, this is the simplest. So I'm going to use the example again. We're conventional, mostly the market bid offer spread that you're going to see on TradeWeb or Bloomberg is going to be a tick. I'm going to use the example of a tick and a half because, as you guys all know who trade, as we see a transition in coupons like we just have seen, we're seeing a little bit more nasty bid offer spreads here. You've got clients of ours, and all of you guys are seeing situations where you need to have a 5.5 coupon, which just simply is not a market TBA right now, even though from a yield perspective it should be a market TBA. It just simply has too wide of a bid offer spread. So you're seeing these. So this is a classic example where you very easily, in conventional production, and we'll talk about Ginnies in a second, you very easily could see a 1.5 bid offer spread. So if we think the standard bid offer spread for the broker dealer off of the screen is a 0.5 tick, and I should have said just to take a step back, a tick is 1/32. 1/32 is 3.125 basis points. So when we talk about 2 ticks, we're talking about 2 times 3.125 basis points, or 6.25 basis points. So in the example of a situation where we are going to over deliver against that million, we are going to basically just apply that pickup linearly to the 4 loans. We would not recommend in the best X to apply that pickup, apply an 80 basis point pickup among the 5. This will achieve you mathematically the best execution. Basically applying it to the 4, assigning the 5 if it wins, but applying it to the 4. Again, when I was using my example of the 5 earlier, I was talking about operational efficiencies. This is now your best execution. So in this case, we are going to bias the execution against other non-assignable investor executions by 6.25 basis points. Again, that is just using this example, okay? And that's for those 4 loans. So again, for 4 out of the 5, we would bias 6.25 positive. 1 out of the 5 would not get biased at all in this best execution example. When I say bias, the reason I say that, I talk about adjusted price will not match the commitment. So this is simply obviously for ordering, right? There's that 6.25 basis points, to be clear for everybody on the call here, has nothing to do with your loans, right? This is purely from a trade standpoint. It's the fact that you are able to assign that trade to the investor enables you to achieve those 6.25 basis points. However, we have to put that in the best X. It's the same, with, file fees, right? File fees are a pain to take into account because you have to reduce everybody's price, but it won't match the commitment price, right? The commitment price. So file fee adjustments adjust the order of the best X, but they don't actually adjust the price, to be clear. So this is the simplest case. So now let's talk about the the exciting piece for smaller lenders is under delivering. Not that all investors are looking to see a lot more trades than they do loans. Again, it's generally just rounding up to the next million. But you can see the advantage here. So using this example, and I spoke a little bit to it earlier, we've got our 5 loan best X, only 3 loans best X to the assignable investor, assignable execution, I should say. And 2 of the loans best X to somebody else, some non-assignable execution. Maybe it's Fannie Cash Window, Freddie Cash Window, maybe it's some other investor bid tape that doesn't have an AOT. So now you've got a situation where you're saving 6.25 basis points, but you're saving it on a million. So the correct math on this is to multiply it by your ratio. So your assignment ratio in this case is 1.33. So you're not saving 6.25 basis points, you're saving 8.3. Now that's a huge number in a in conventional execution. if we just step into where the real meat here is that, in the Ginnies, as you guys know, right now, Ginny 5s, we've transitioned into that being a legitimate coupon. There's a lot of volume in the Ginny 5s, and they are trading somewhere between 2.5 ticks. Let's just say that they're 2.5 ticks right now, for purposes of showing the extreme pickup here. You have a half tick to the dealer. You now have a 3/32 bid offer spread. That's 9 3/8 basis points. When we apply the ratio, you get 1/8 of a point. And so you cannot overstate the value of 1/8 of a point on what is supposed to be one of the most efficient assets in the world to trade. That's a huge pickup. So now again, I'm using an example for purposes of purposes of showing the magnitude here. Obviously, not all Ginnies trade on 2.5 tick bid offer spreads on the screen, but all of you can see those screens right now, and the 5s are not trading at a half tick to a tick. We all know that, and so those are big differences. And you can see that if you were to widen that out, let's say there are some of the programs will allow you to assign 501,000 in loans versus the million in trades. Now you're basically doubling it. So you're doing a ratio of 2. So you're going from 9.375 basis points to virtually 18 5/8 at that point, 18 3/4. So you can see the value here is huge from a standpoint of where bid offer spreads are right now. This could not have come at a better time. There were a lot of us in the market that were a little concerned on the Ginny trading as the ones went away and we went into the 2s. There's no question that the liquidity on the screens has not been what it once was. So here are the programs available. Wells Fargo, they were on, the first to, we were the first, they were the first to work with us on automating the assignment of trade, the tri-party into our BAM platform. That started back in February. Amerihome and PennyMac have just worked real hard with us, and they have their programs. And I want to make clear that these are not just with MCT, but we're very proud that these are automated on our platform. So moving down here to Franklin. Franklin has had a program, a BidTape AOT program, I believe for over a year. Wells was the first one with us to really work with us on automating the tri-party because of the scale of trades that we do. Citi, we have done a few of these with Citi. Freedom is currently in a pilot program, and I believe they will be loading that up to the majority of their clients, I believe, in the coming weeks. And then we have a lot of other, there's a lot of others that are in process. There's a large depository not named here that is working on this as well. And without naming names, I think there is definitely there's definitely been some interest from the agencies as well. So there are nuances between these programs. When I was preparing this, I didn't want to pitch one program over the other. So I would definitely recommend if you're an MCT client to talk to your MCT trader or your sales coverage. If you are not a client, I would definitely recommend that you talk directly to the corresponding investor. So just Bid Auction Manager, what our platform is. I think that we are really this was born out of a need for security in bid tapes, moving away from emails, with the property address. It's in this context, it's provided a very good platform for us to work with investors to automate the AOT process, because there are, as I talked about it, there are pieces like the tri-party, the transmission of the trade, that create time, they're resource intensive, and also can be problematic from a human error standpoint. So we're real happy to say that we have automated the tri-party process with these investors that are doing these tri-parties at scale. Just to kind of speak to our relationship with the bid tape AOT. Look, we're proud that this presentation was not a sales pitch or anything. Make no mistake about it. We see this as a competitive advantage versus our peers in the industry, because of the fact that we have this process automated. The process is essential to be automated, and we're going to push it accordingly. We really don't make any apologies for that, because this is a program that is providing a ton of liquidity to the market at a very needed time. I spoke a lot about lenders from a lender perspective. Hopefully for the investors on the call, the aggregators on the call, you could see that this is a win-win, because this is a product that provides better execution for the lender, right, without you having to give up margin. So basically makes you more competitive. So, again, us being lender centric, focusing on the lender, but there's no question that this, that we think this bid tape AOT will truly dominate the market. And it should. And again, when I say we're available and we're applicable, there is the fact that you need some level of scale. If you're going to buy, if you're an aggregator that's going to buy one $90,000 loan in a 50 loan pool, that's problematic for us or for anyone, from an assignment standpoint. So it's not always going to be applicable. Provided the price is there, obviously we're going to execute it. From percentage basis, I think when we use the terms dominate, we expect somewhere between 40 and 60% of production, of our clients' production, to be assigned in really in the coming 6 months or so. Again, really the benefit here is just provides the bid offer savings and the cash flow advantages while preserving the pricing granularity. And the last thing I'll say is, again, the process has to be automated. I think we've all come a long way. All of us in the industry have come a long way, in trying to, in first, hitting this bid tape issue of, let's call it 2014, 2015, where we had a lot of executions coming in, trying to handle them all. I think all of us in the industry have worked real hard on automating, both on the investor side, providing pricing to us and the lenders very quickly, and also on the lender side, trying to true up all of these bid tapes at different market levels. But we want to be able to keep that efficiency and remove, most importantly, remove the human error and from an accuracy and risk standpoint. So with so many people on the call. I would love to do a Q&A, but I don't think that's going to be really viable here. So what we're going to do is this presentation will be sent out to all of you with, as far as questions, specific questions for us. You can ask myself or our two senior traders, Justin Grant and Andrew Rhodes. And or like I said, specific to the investor product, it's going to be by far the best is going to be talking directly to your investor. But with that, I appreciate everyone's time, and thank you for getting on this call. We really think that this is a extremely valuable execution at an extremely important time. Thank you very much.
Thanks, Phil. And just for everybody here on the call, we are going to be sending out the slide deck this afternoon and the full recording and a recap blog post sometime next week. Thank you all for joining us, and have a wonderful day.